Hi there. If you earn extra income from freelancing, online selling, or content creation, here's what UK tax reporting rules mean in 2026-27.
I'm a consultant with Atlas Tax Advisors. Imagine checking your mail and finding a formal inquiry from HMRC, not over your day job, but over the clothes you sold on Vinted or the crafts you listed on Etsy. Despite the headlines you might have seen, there is no new side hustle tax for the 2026-27 tax year. The laws governing what you owe are the same as they were last year. What has changed is HMRC's ability to see exactly what you're doing. HMRC has invested £39.9 million into automated systems. These tools pull raw data directly from e-commerce and gig economy platforms, route it into a centralized database, and cross-reference those earnings against your individual tax file. For the UK PAYE employee, the risk lies in the discrepancy between what you consider a hobby and what HMRC's computers flag as undeclared income. You aren't trying to outsmart a human auditor anymore. When the software detects a mismatch between platform data and your filed return, it triggers an inquiry automatically. This visibility is driven by the OECD Digital Platform Reporting Rules. This international mandate legally forces platforms like eBay, Airbnb, and Depop to hand over user transaction data directly to HMRC. The platforms track your activity over the calendar year. If you hit just one of two markers, completing 30 individual sales or generating £1,700 in total gross revenue, your data is automatically packaged and sent to the tax office. Once that trigger is hit and HMRC has your transaction logs, the burden of proof shifts. You now have to demonstrate that your activity is not a commercial enterprise. If you are clearing out your closet and selling old clothes at a loss, that isn't taxable trading. But because the platform reported you, you still need the records to prove you were disposing of personal items rather than running a business. Being reported doesn't automatically generate a tax bill, but it guarantees HMRC is watching, which means you must maintain evidence to defend your non-taxable status. Your legal entry point for compliance is the statutory £1,000 trading allowance. This is a strict threshold based on your total gross income, the money you take in across all your side hustles combined, before you deduct a single expense. If your total gross income exceeds £1,000 in a tax year, you are legally required to register for self-assessment. You must do this by October 5th following the end of that tax year. Missing this deadline triggers an automatic £100 penalty. You may have seen reports about a new £3,000 reporting threshold. That is a future proposal for the 2027-28 tax year, not currently the law. The trade-off here is administrative. Claiming the trading allowance against your income might bring your actual tax bill to zero if profits are small. However, the obligation to register and file the return remains. For the 2026-27 tax year, the £1,000 gross limit is the absolute legal boundary for compliance. If your side hustle turns a profit, the way the UK taxes that money catches many people off guard. Your self-employed net profit is stacked directly on top of your full-time PAYE salary. Your day job uses up your £12,570 tax-free allowance. Therefore, your side hustle profit is subjected to your marginal income tax rate, typically 20% or 40%. Additionally, if self-employed profits exceed £12,570, you'll pay an extra 6% in national insurance. This creates a significant cash flow gap. Tax for money earned this September won't be due until the end of January, over a year later. Because of these stacked marginal rates, set aside 25 to 30% of your gross earnings from day one. If you wait until January to try and find the money, the bill will likely exceed your available cash. For higher earners, the administration requirements change significantly in April 2026. This is when the Making Tax Digital mandate takes effect for anyone with a combined self-employed and property gross income over £50,000. This replaces the annual self-assessment filing. You will be required to submit digital summaries of your income and expenses to HMRC every 3 months. While this provides a clearer, real-time view of your tax position, it ends the era of paper records and standalone spreadsheets. You will be forced to use HMRC-compatible accounting software to track and submit your data. Crossing the £50,000 threshold moves your tax reporting into a continuous cycle of 4 digital updates a year. The process is mandatory, automated, and software dependent. To stay compliant in 2026-27, you need to identify where your gross side income places you: under £1,000, between £1,001 and £49,999, or over £50,000. If your total gross revenue stays under £1,000, keep a basic log of your sales to prove your income stayed below the limit. You have no reporting duties. If you fall between £1,001 and £49,999, you must register for self-assessment. Open a separate business bank account immediately. This isolated record is your primary defense if HMRC flags a discrepancy. If your combined income exceeds £50,000, you need to select and integrate MTD-compatible software well before the April 2026 deadline. Remember, while the flat-rate home working allowance is restricted for PAYE employees, self-employed individuals can still claim home office expenses. Proper tax structuring ensures you recover costs that you are legally entitled to. Need help registering for self-assessment, setting up Making Tax digital software, or building a profit extraction strategy? Reach out to us at Atlas Tax Advisors. This video provides general guidance. UK tax rules are complex and subject to change, so you should seek specific advice from qualified professionals before making any financial decisions.